Welcome! Today I am very excited to have on the legend. You guys know him, Michael, founder of Curve, and currently building YieldBasis, which is kind of one of the purposes of having you on, because I've read through a bit of the documents and I've talked to a few of the people that are associated with the team, either as investors or builders, and I am still highly confused about how you guys are going to achieve sort of some of the high promises. So very excited to have you on. Thank you so much for joining. Can you give people kind of like a short version of what YieldBasis is and what it's trying to accomplish?
Sure. So YieldBasis is built on top of Curve, and it uses Curve pools to essentially earn yield from volatility while eliminating impermanent loss. So you have essentially, you essentially convert some volatile asset to a yield-bearing volatile asset, and the yield is earned from the price fluctuations essentially. But looks like the best yield, the best yield profile is given by Bitcoin, so which is interesting.
All right, now so you posted this, let's say recently, maybe a week and a half ago, and It looks insane, obviously. And there are two claims you make. One, there's yield effectively on Bitcoin, which is a nut that no one has really cracked. I think, Solve tried this, and they've done a pretty good job. Solve targets between 2 to 3% pretty consistently. What they're doing is they're just rehypothecating Bitcoin. So people bring on Bitcoin, they custody it, they borrow stables against it, and they do all sorts of stuff. There's a Midas is doing something similar here as well, but no one has been able to beat that like 3%, which is what you can kind of do yourself.
Yeah, well, this it's not so much about having it on Bitcoin, really. It's more about eliminating impermanent loss, I guess. But why Bitcoin?
Okay, well, explain that to me. Well, first of all, this deposit growth. What are you showing here with this graph?
This is how much, by how much, if you hypothetically start from the beginning of 2023, which is apparently an incredibly bad time, how much your deposit in Bitcoins, let's say you deposit 1 BTC, how much it would grow if you run this algorithm through, if you run it till about now. So it looks like
you're on annualized 20, well, about 17%,
yeah,
15 to 17.
Yeah, I think a little bit under 20. That's right. Average.
And so that's crazy, right? I think anyone who's ever been in BTC would say, how is that possible?
Yeah, keep in mind that it's not like always like that. Like, for example, if you look at the graph,
there are some flatter
beginning
periods.
of 2023 was, I don't know, like nothing, right? And that was right after FTX collapse, so markets kind of died. And even though the price, it did go up and down, of course, but the market was not very active, and I think that's probably why this is like not really making any profits. But after that, Bitcoin started ETFing, rumors about Bitcoin ETF.
That's right.
And it actually materialized. And later on, we've got some US elections and Trump. And that's, I guess that's probably, probably one of the greatest presidents for volatility, which is great.
Yeah. In terms of lack of volatility, we really dodged a bullet there. No pun intended, because he, got shot. Anyways, question. So you have these really high returns. I'm, slowly grasping what you're talking about. You've mentioned that there's no impermanent loss, and there are returns. Before we get to the no impermanent loss side, which I think is really going to be where I'm going to ask you so many questions, the returns. Where is the yield coming from for YieldBasis?
Right. So the yield is coming from essentially people exchanging Bitcoin for stable and back, right? But actually the yield is much, much less than the total of fees which the people who exchanged this wrapped Bitcoin were charged. I think vast majority of the fees charged goes to rebalances, essentially, to different sources to cover different sources of losses which are inevitable, and what is left is the yield. And the trick is, of course, to have revenues being bigger than the expenses in the algorithm.
So what I'm hearing is that there's effectively an LP. It's an LP. And is it a curve LP?
It's a curve LP. So the underlying pool is a curve crypto pool with few modifications we just did recently. By the way, these modifications are great not just for YieldBasis, they are also great for foreign exchange swaps, for example, like between USD and non-USD fiat currencies, or like for swapping gold to stablecoins and whatever. So it actually has, the new updates have really many applications, and YieldBasis is one of those applications. So although it's a very small modification of the original crypto swap, but it appears to be very, very interesting thing.
Okay, so there is swapping between BTC and Curve USD on Curve. Now, automatically rebalanced by built-in AMM. Most of these are automatically rebalanced, right? So is this different than your traditional Curve LP, or is the automatic rebalancing just...
Well, so you have an LP in Curve pool, but that would have still impermanent loss, and it does.
Of course.
And we want to get rid of it. To get rid of this impermanent loss, this LP is used as collateral.
Right, to borrow more CRV
for the
USD?
leverage position. So this LP is leveraged by a factor of 2. It's a compounding leverage, so you keep LTV at like always 50%. That would make compounding leverage factor of 2. And when you apply it to LP, apparently this makes the price of your resultant position being a square of your LP price. But LP price on Curve, just like on Uniswap 2, although it has concentrated liquidity, just like on Uniswap 2, has price proportional to square root of Bitcoin price. So this square cancels out with square root, and you have price of your leveraged LP being proportional to Bitcoin price plus the earnings you make.
So we experienced this last cycle. We called it PDN, right? Pseudo delta neutral was what people were calling this, because when you were exposed to an LP and you would 2x leverage this, there was still some degree of impermanent loss, either due to rebalancing or for whatever reason.
Yeah. So what happens is this: it's a compounding leverage. Remember. Which means that you need to change the loan size all the time. So if Bitcoin goes up, your collateral goes up as well. And all of a sudden, your loan is not 50%, but let's say 49%, 48%,
right. You're no longer as short,
and so on. And that would really break this square dependency. And you don't want that, because that square dependency is what saves you from impermanent loss. So you need to borrow more and buy more of this collateral. And that is done, of course, by a special AMM. So you don't do that. You do that passively, but doesn't matter. You still do it. And because you do it all the time, when it goes up and it goes down, then you inevitably will have some losses.
So the pseudo and pseudo delta neutral is by virtue of the fact that when you are borrowing stables against an LP position and then longing the LP position again, you are literally longing Bitcoin to some proportion.
Yeah.
And if your loan size changes, now your delta also changes. And so this has always been the struggle for anyone trying to run this strategy themselves. And so the way that you guys remove the P from the PDN, the pseudo delta neutral, is that you're saying the delta effectively is a virtue of the loan size. The loan size has to be a specific size relative to the notional. And if it's not, then you fall into that pseudo delta neutral area, that gray zone. And by mitigating that, by rebalancing constantly and automatically, you can close any of that delta that would otherwise exist from someone sort of just leveraging your average, full range LP.
Yeah, pretty much. I think that's a good way to explain it.
Okay,
but
this is
keep in mind that you are speaking in very financial terms, and I'm not really used to financial terms. So, but yes,
I'm DeFi native, so hopefully most of these terms are semi. PDN was like, I kind of credit Solana. Alpha Homora. I don't know if you remember those days, but there were a lot of Francium on Solana. There was also Tulipa. They did a lot of these borrow against your LPs and then go and leverage these things. And you're delta neutral, they said, but they were doing the opposite. They were, because this was during the beginning of the bear market last cycle. You could have a Sol USDC LP, but you didn't want to be exposed to Sol at that time. And, for good reason, right before FTX collapsed. So you would short this Sol, you'd borrow Sol, sell that, and put it into the more LP. So now you're pseudo delta neutral on dollars, which was the goal. But if you weren't rebalancing all of the time, you would end up having a short or long position unintentionally.
Yeah. Well, the thing is that why I'm not doing that with dollars, you just saw what returns it does. Somewhere between 10 and 20%, essentially.
Right.
And while these returns on Bitcoin sound pretty good, like very good, like probably almost an order of magnitude better than what you can get elsewhere.
Yes.
On US dollar, it sounds comparable to what you can get in curve pools, for example, with all the incentives and whatever. So, or I don't know, or some yield-bearing stablecoins give you 10%. So it's not really that different from what you can get elsewhere. And on maybe there are some good other yield sources on USD. But here's the thing. Maybe I need to, like, as a next step, I could really think what happens if I take some yield bearing USD and take the yield from that USD and also put it.
There you go. Yeah, you combine those two things.
As investing in the system's efficiency. Will it go really crazily better? So that's a nice idea as for like next steps, essentially.
Please do that. It could be like a curve squared USD or something, and then you have this additional yield benefit.
Well, I mean, it would still be like I don't know. Well, you still can make it USD, USD priced, but I somehow think that it's still better to have essentially yield bearing cryptos
Bitcoin
from this. Yeah, or like Bitcoin,
ETH
Ethereum. I don't know what else can we have. Gold?
It's a good question. Like, I mean, people in terms of what is super exciting on ETH main. I think we have liquidity as one of the tried and true assets. Curve is another obvious asset. Aave, people have never been able to get a yield on Aave. I think they're still complaining about that. Never been able to get a yield on most of the what we call blue chips, and then of course Hive from Hyperliquid. But the big boys are always going to be BTC and ETH.
Yeah, I think with blue chips, it's maybe still possible, but definitely harder than Ethereum. And on Ethereum, it's harder than for Bitcoin, apparently, because it's more volatile. And for maybe meme coins, forget it. It will not work. It's too volatile, right? So apparently you need something volatile, but kind of returning to some sort of trend line price. Right. Well, I mean, as an example, if you have some token which can change instantly by the price instantly by a factor of 2, right? Well, either way, either drop or go up, then this can pretty much screw the algorithm, right? So that's probably not something we want to use.
There we go. My gosh, I lost connection for a second there. I'm back.
All right. Yeah. So what I was telling is that if you use some asset which is more volatile than Bitcoin, imagine some asset which can drop or grow by a factor of 2, 3, or 4 instantly. And that sounds crazy, but it can happen for some assets, and you probably don't want to use this algorithm for these assets. But Bitcoin sounds very stable in this regard, so it doesn't actually do this anymore. Bitcoin did it when Mt. Gox collapsed. I observed that, but it was a very long time ago. Right now, it's only like very speculative coins which do that.
Yeah, I mean, it has been said that crypto is the pond where the black swans live. There are, in TradFi and other places, black swans are relatively rare. Maybe you get 1, 2, 3 a decade.
In TradFi, actually, I would say black swans in TradFi happen quite a bit often, I guess. Well, not like completely black swans, but still.
Gray swans.
Maybe, yeah. Like for example, in the past I worked at LinkedIn, right? And well, as an employee, I was getting stock options, and stock was like around $200 or something. But anyway, I went to start my own company, so I left LinkedIn, and of course I sold all my LinkedIn vested stocks. And at some point when I was working on the new company, which was, by the way, New Cypher, which now contributes to Threshold BTC. So when I already was working fully on that company, I noticed the graph of LinkedIn stock. It apparently dropped from like 180 to 120 instantly. So I cannot imagine that with Bitcoin.
Right.
Actually.
Yeah. I mean, it's a good. Well,
Right.
I wonder if it's by virtue of distribution. But go ahead.
So it does happen
Right.
with stocks, and these stocks are not really bad stocks necessarily. So it happens.
So one of the questions I have under that end is, you guys have chosen BTC, which I think is the best one. I mentioned before that Bitcoin is kind of in this weird place where it is the largest by a large factor crypto asset, period. And yet it is one of the hardest to get a yield on.
Well, here the reason was not because it's most attractive for the yield, really. It was because for this particular algorithm, it is the easiest to get yield on safely.
And that is because of the lower relative level of volatility, right?
I think so, but it's an interesting kind of volatility. So if you apply crypto swaps to euro-dollar pair, the yield is not there. It's completely taken away by, I don't know, traders. It's just, you cannot just make it in euro-dollar pair. It's volatility is kind of there, but it's smoothened. So it's very smooth graph, which, I don't know, when things happen, it smoothly goes up or smoothly goes down and doesn't fluctuate on the way. For Bitcoin, it's not the case. Bitcoin does fluctuate on the way. It's just not doing very drastic moves, but it has a very how to say, high frequency volatility, right? So it has a lot of short-term volatility, but it kind of returns to the trend line, and that's ideal, right? So Bitcoin sounds very good for this. You need something which is volatile, but not volatile in a way that it just diverges the price somewhere. So it kind of has to return back more or less. I actually what would be nice to do also theoretically is to compare how the prices which work well with this method, how do they stand against Brownian motion, for example, right? So are they super Brownian or something? Like what really happens? So that would be an interesting one, I would say.
There's another question gets raised here, which is, if the reason why Bitcoin is a better asset than virtually any other asset to do this specific thing with, also liquidity depth is going to be huge here. How frequently does rebalancing have to occur for this feature to exist?
Right. Yeah, I actually I actually ran an experiment. So you have two kinds of rebalancing. One is connected to how curve crypto pools work, essentially. Curve crypto pools have dense liquidity, right? And this dense liquidity is moving around, so it is automatically managed. When it is managed successfully, so that this dense liquidity manages to follow the price without getting stuck, then it moves it with every swap over there, but optimal fee in the AMM appears to be fairly big, and fee is essentially the same as spread, so spread is pretty big. And then it appears that in calm times, you probably get one transaction every few hours. I would say that.
One rebalancing transaction.
That's one swap, but you rebalance with every swap. But this is a rebalancing which is moving concentrated liquidity. But there is another thing which I would call re-leverage, which is the change in the loan size, right? You probably asked about that. This happens apparently much more rarely. It happens when it's profitable for arbitrage traders to do it. And it looks like on average once every several days, but if Bitcoin becomes very volatile, it can happen many times an hour, or like maybe every minute. It's really not tied to time, it's more tied to price movements. But on average this changing of loan size re-leverage appears to be once every several days, more or less, until of course volatility goes high. Then it kind of spikes much more.
Now, if volatility goes high, also fees would increase and APR increases. Another question I have here is if there is even micro IL, is the end user taking any exposure to that, or is the end user only exposed to like the net after IL is covered by the fees, and the end user gets whatever remaining as an APR?
Well, I would say that LPs, you can, if you open again that graph which I posted, you can see those, especially in the beginning of 2023, you can see those micro bumps, kind of, right? So you can see that sometimes it's going down, right? Well, hard to see, yeah, I know, but it does. And this is real. I think this is realization of IL essentially. So you do realize IL, but usually when IL happens abruptly, it means that volatility is high, and when volatility is high, you're earning fees quite fast, and you kind of get the graph going up. But this is not necessarily. This was not necessarily the case all the time in the beginning of 2023, as I said. So it was kind of on average going up, but you did have those micro bumps. So this is, well, what happens if you have, I don't know, if you have things crashing, but not really a lot of trading happening after that. So it's like somebody sold a huge chunk of Bitcoin, and people just didn't trade much after, right? So that's a kind of a bad situation, right? So, and a good situation is when Bitcoin goes up or down, whatever, and then volatility is happening, like going up and down again, so on. So that's when it actually does make money, and that's what happens most of the times. But yeah, well,
a question here. So I know you guys are doing effectively a 2x leverage on the LP, which is a 1x delta exposure to BTC, roughly. Do you anticipate ever having products that increase that leverage, or will this be like a standalone?
I actually wrote the smart contract in such a way that you can specify any leverage, so you can use it in principle for leverage tokens. Of course, then it's a different product, but it's possible.
Of course.
And yes, you can make BTC 2x essentially, which grows up by factor of 4 when BTC goes up by factor of 2 or something like that. But keep in mind that I think inevitably if you do that, then you will have some loss. So essentially what I mean by that, of course, yes, if Bitcoin goes up by factor of 2, that leverage token goes up by factor of 4. And imagine now Bitcoin goes up by factor of 2 and then goes down by factor of 2, right? In ideal world, you should return to the same price of leverage token.
Right.
But I think what will happen, the losses will be, there will be some losses, and even if you leverage the LP, probably losses will be higher than profits over there, and with the leverage token, and maybe you will have this round trip will get you to less value than you put in, and
it'll be more than a round trip. You'll come all the way back to where you started and then go a little bit back behind.
Right. So I think people saw that with leverage tokens, which Binance did, although they were a little bit, I would say.
Oh, you mean the leverage ETF tokens?
No, I think not ETF. There were leverage tokens on actual Binance, I remember. So they made a strategy which was absolutely manual, right? So it just leveraged BTC, and it was like compounding leverage essentially. They were applying this re-leverage, I think, every day. Right, so they adjusted the LTV ratio, so to say, every day. But this was every day regardless of what the price is doing.
Right. So someone who may have started off 2x leverage with a specific notional is now rebalanced at a 2x leverage at a different price, and so their effective leverage has actually changed.
Yeah. So if you do it this way, then losses are fairly high, and you don't want to be exposed to that for a long time. And people tried to actually use it to be exposed to it for a long time, so they didn't really like the losses, and I think they shut down the product because of that. But yeah, I think over here, if you apply this releverage AMM, which I have, to leverage tokens, the losses will be less, but there will be losses, I'm sure. So it will be kind of fundamentally the same problem. And I think that yield-bearing Bitcoin would be a better value proposition to start from.
Yeah, it certainly has PMF. We've seen wherever a good yield-bearing Bitcoin product comes out, a lot of capital flocks to it because there's nowhere to really source these yields, which is the next question I have is, you mentioned that you built a product where if people wanted to, they could use the same infrastructure to take on different leverage exposure or, effectively choose their own adventure. But will this product be composable? Like, will there be like a YieldBasis BTC that people can take then and use in DeFi as a composable yield-bearing Bitcoin product? Or do you anticipate it just being a vault people can deposit into?
I think actually it will be composable because I've built token economics deliberately in such a way that it's easy to compose. Normally in DeFi, you have a lot of farming happening, right? So where you put liquidity, and apart from natural yield, you get some protocol tokens, which you can use for whatever purposes. You can, you can use them in protocol. You can sell them. You can do whatever you like. Here, I actually split between LPs who want to earn protocol tokens and LPs who want to earn real yield. So you either have auto-compounding Bitcoin essentially, or you have constant number of Bitcoins earning YB tokens.
And so in this case, anyone who's doing the real yield is getting twice, well, let's just say it's 50-50. They'd be getting twice the exposure to the real yield as they would if everyone was getting the real yield.
Well, pretty much. So that's pretty much the idea. There is also dynamic admin fee depending on that, but yes, that's the idea. And what will likely happen if, for whatever reason, yield in YB token part is bigger than yield in like natural yield part, most likely people will stake to get YB tokens, and that will happen until these yields equalize with each other.
Right.
So it will not actually matter which one to use. And the natural yield version is actually very easy to compose, right? So it's easy to use it in lending, where you can loop it with, with borrowing Bitcoin. So you probably can check, what's the rate on borrowing WBTC on Avi today, for example. If this gets as collateral on Avi, then you can borrow WBTC on that against yield YB BTC, loop it, and earn like the multiplied difference, and do it until borrowing WBTC becomes too expensive, because you and people like you pushed borrowing rates up, right? And then by you doing the looping, people who deposit WBTC will get some yield as well. So it's kind of a journey of yield here.
You're also pushing up the yield for lenders, which is something that we haven't seen before. Lenders are getting what, 5 to 15 bips if they're 5 bips is normal. 15 bips would be insane for lending wrapped Bitcoin. So we start to see that go up too. It means a lot of other products are the beneficiary of this.
Yeah, I think lending protocols would benefit from it.
Now, another question here. Well, actually, not really an important question, but I've heard this mechanism called yield discrimination. Have you heard this before?
No, not really.
So it's it's the Athena model, the DAI model, the SUSDS model, where you have one version that is getting the real yield and the one version that's not getting any real yield. Now, in your case, both versions are getting yield instead of just points, or they're getting real tokens.
Right. So it's like USDE versus USD, and so
exactly right. Yeah, the yield is discriminating against USDE while giving all of the yield towards SUSDE.
Yeah, I think that's actually comparable to that in a sense. You're right.
But in this case, instead of just farming points, and those points will probably dry up eventually. I don't think Ethereum can do forever seasons, though EtherFi is trying to do that. You guys are saying there will be real incentives in YB tokens. Will there also be a points campaign?
No points.
So will the token launch like day one with the product?
No. So I think first when the product will be launched, token will be still not up for a little bit of time, right?
Mm-hmm.
And this time wouldn't be too long, but still it would be like, I don't know, probably for several weeks or so. It will be product running without token live, and then when token goes live, then the emissions start, and you would be able to earn YB tokens.
Well, this presents an interesting question because if you have this like stake for the yield bearing version, stake for the token bearing version, will you run a pre-mining campaign so that you get the boosted yield on the native version and like make sure there's people on that other side, or will you have this natural APR existing at a lower rate for a while and then get a boost because now you've launched a token, now you can launch this secondary vault?
Well, I think it's important to not to probably not necessarily overdrive too many people in the first weeks when it's up, right? Because everything is tested and audited and everything, but still when you run it in prod, it always feels like testing prod, right? So that's why it's probably better that when a few weeks run in a more or less natural course.
Now, when you do that, will it be a live launch that anyone can deposit into, or will it be a gated launch initially? Do you have a plan for that?
I think in principle everyone can deposit, but it just wouldn't be encouraging to have like billions in there in the first weeks, right?
Encouraging in some sense because a lot of faith in the product, but maybe discouraging in the fact that now you're terrified.
Right. Yeah. Well, I mean, it's it wouldn't happen like so quickly anyway, I would say, because like you really need some. I don't know. I think you still need the token to be alive to kind of amplify the growth. It can grow
to fully realize the system.
It can grow without the token, but it wouldn't be that fast. I think you kind of still, even with 20% on Bitcoin, it's still not like it still wouldn't grow as crazy as billions in several weeks. So and
you should do tranching where you have two vaults, and then the junior tranche eats all the impermanent loss but gets a higher portion of the yield, and the senior tranche gets a lower yield, like 5% net on Bitcoin, and then is totally mitigated from impermanent loss. I'm only saying this because we've seen so many tranching protocols come out lately, and it would also be interesting to get your take on that if you have any opinion on it.
I don't know. I think I'm more liking simple things, like when protocol does as best as it can do in the product which is available for everyone. And of course there could be secondary products which work as an insurance on yield, which gets resold, and it could be something like Pendle, or even looping on Avi works in a similar way in some sense. So you have probably more stable yield on one side. And
well, there's another question here, which is, it is a Bitcoin denominated product, but there may be some peg variability from like wrap Bitcoin. Well, there's another question here, which is, it is a Bitcoin denominated product, but there may be some peg variability from like wrap Bitcoin, for example. There could be days where you see slight decrease in NAV from rebalancing or from whatever it may be. So leveraging through a market rate or an NAV oracle would still potentially be beholden to risks, unlike an ST-ETH or a wrap staked ETH, I guess. So do you anticipate that looping and leveraging will push the same sort of LTVs we see with like YBSs, yield-bearing stables, or do you think that the LTVs will probably be more conservative? And what kind of oracles do you expect for these money markets to be using?
So which oracles you mean for example, well, what I've seen actually, I've seen that for whatever reason, Avi started switching from Oracle, which is pegged to like Ether instead of market ST ETH price,
Right.
right? And I didn't see an announcement about that, but I've seen that in the code, and that kind of surprised me. But I think it's kind of fair, but then lending protocols rely on they really over rely on the asset which is used as collateral, right? So if there is some fundamental reason for STETH to go down, some hack or whatever, then of course it would be a problem for all the Avi, but it probably will not happen because it's a very, very safe asset in reality. but yeah, I'm still kind of uncomfortable with doing this with using this kind of
There are two different approaches that I've seen. One of them is a lot more scary than the other. I think Aave at some point had a hard-coded oracle, which is like one-to-one pricing for STETH to ETH, and that is kind of terrifying. But then there's NAV oracles, which I think are less scary. NAV is, just like how much ETH is backing
I know.
the...
Oh, yeah.
As long as that's not exploited...
It's NAV. It's NAV oracle. But yeah, question is what happens if there is a technical problem there, right? So will NAV oracle detect this technical problem, or
Sure.
what really will happen?
Because people always they think NAV is perfectly sound, but then if there's a slashing event, then the NAV does go down.
Yeah, if slashing happens, NAV does go down, so it's fine. Yeah, so it's resilient to that. But of course there is a discount. And I don't know. I think at least using NAV Oracle for SUSDE is not very good, because SUSD can be off the peg for a week, for example, for the essentially withdrawal time. With STETH, I didn't really see that happening, at least not when redemptions were switched on for staking.
Exactly right. If redemptions are decentralized, there's a totally different risk profile than if redemptions are only institutional, which is what we see with SUSDE.
Right.
And of course, like, what is the institutional redemption in terms of? Well, for them, it's USDT, but for staked ETH, it's just ETH, right? There's no like different variations of ETH that you're being exposed to after redemption.
Right. When NAV Oracle works really well, and where it's safe to use, is actually in curve pools. So you can use stable swap pools, which normally peg asset to 1.0, right? But here you have WSTETH, for example, going up and up and up, and you move the center of liquidity to the price determined by NAV Oracle. Right, and that is a totally different safety profile than liquidations on Avi. Like in the worst case, if one of the assets goes very, very low, you will have the pool sitting in that asset, and that's what will happen regardless of like whether you use NAV Oracle or not. So NAV Oracle is actually good to use in stable swap pools, and NAV Oracles also normally go up only, and this is also very good for stable swap pools. So
yeah, I agree, and it's NAV Oracles normally go up only, up and to the right. But there are very niche cases where they could potentially go down. And I think a lot of people don't. I mean, they discount it, and I get why they discount it, because it like we've never, as far as I know, we haven't ever seen like an ETH slashing event or any staked derivative having any serious slashing event that would impact NAV, or even any stablecoin exploit that has affected the underlying NAV specifically of like the YBS. Actually, I wanted to point. I don't know if you guys are familiar with this, but this is a protocol that I was checking out before, which is asymmetry, and you guys were, staked curve USD was collateral over there.
Yep.
And I'm a massive fan of Liquidity and like Liquidity V2 and Bold and what they're doing over there. And so this is one of the Liquidity V2 forks, one of their friendly forks. And so here I actually asked them, like, what are you guys doing on the Oracle side? And they're of course using market rate oracles, which I think is the right move here, because they want to have this as like asymmetry is immutable, Ibisu is mutable. But do you have any like opinion on the Liquidity V2 fork narrative and landscape and the way they're going about their growth?
Yeah, I don't know. I didn't really I didn't really look too deeply, but obviously liquidity is a very solid protocol. The only thing I don't really like with forks of liquidity V1 or V2 is redemptions, right? So redemptions instead of, well, the redemptions as a stabilization thing is something which I don't want to be exposed to, I would say, as a user.
And I don't know, there was the there was the season which was, I forget the names of all the protocols, but it was like the Liquidity V1 fork season, and there were so many of these things that came out, and they didn't have, the ones that did have redemption burned all the users because the users who put collateral and then got redeemed when there were massive depegs, because the real value of using these forked protocols was just to leverage these things as highly as possible and farm the airdrop, farm the rewards, and then they didn't really work. And the ones that didn't have a PSM, because they're like, oh no, people don't like redemptions, we won't do the redemption, just suffered serious depegs and no one was repaying their debt. And so I think Liquidity V2 was trying to solve for this. And I'm not just here to show Liquidity V2, but the way they, and I'm sure you're familiar with this, the way they do this is like they allow you to choose where you want to be in the queue by virtue of your interest rate. So I think it's a novel-ish, at least, mechanism, and I hope it'll work, specifically because I want to be looping like the S-curve USD yield.
The thing is that these mechanisms introduce complexity, and users these days don't seem to like complexity too much, which is something I'm noticing as a curve builder, essentially. So I'm seeing that if you have something which is not what people are used to see, then they will struggle, and that turns into much less deposits. So
let me give you a tiny bit of pushback there, because I agree. What you're saying is obviously true. And
but
when Pendle came out, no one used it because they don't understand it, right? Pendle, I think Time Wonderland was one of the very first Pendle markets.
Actually did it very well, and it's hard to understand, but people used it.
People used it because the points campaigns were so exciting. And people were like, oh, fixed rate 30% APR on whatever PT Wrap Ether ETH is for season 1. Or, and then Athena was like 60% fixed rate.
If you see high enough APR,
you'll learn.
If the net APR which you can get to 100%, people will learn everything.
Exactly right. Yeah. And so I do think, and now everyone knows, like the Pendle no longer has to have those 100% APRs, 30% APRs. They can target, the 12% APR. On
high APRs, educated users. This is what we had in DeFi somewhere.
I remember those days. It was fantastic. It was good times, but there were also a lot. I don't know. I think the security landscape has changed dramatically. I don't know if you feel the same, but it felt like back in DeFi summer, especially towards the end of the bull market there, everything was getting exploited. Every fork was just a rug. Every old protocol that had, kind of hand-waved audits got exploited. And now we're not seeing that. I mean, knock on wood, we're not seeing that nearly as much. Why do you think that is? Do you think it's that the audit landscape has actually changed, or that teams have been different?
Well, the tooling got much, much better. For example, when I was starting Curve, stateful tests, it's like fuzzing, which is not fuzzing just one call. It's having like a whole random sequence, exploring the parameter space. Wasn't really that wasn't really used when you're writing smart contracts in Solidity, and I was doing that when I was writing smart contracts in Viper, and that was kind of unique. Right now we have people who write in Solidity using Foundry, which really encourages you to write those kinds of tests, and I think tooling got much better, and that turned into a safer code.
Do you have an opinion on formal verification?
Formal verification is, in principle, a very promising thing, of course. But I think that most of most of things you want to find with formal verification, it's you can find them with fuzzing, and you write the tests for fuzzing in ways in some sense similar to how you write formal verification specs, but formal verification specs are sometimes harder to write. So I think that formal verification really should be used only for things where you kind of you cannot hope for fuzzing to find something. For example, I think in certain version of Viper there was some bug of when you call ECDSA, so it didn't quite work. But I wanted to check that you cannot really do anything malicious with it, right? But there are, well, 2 to the power 256 combinations to check, and you cannot really check that by iteration within any time frame you can imagine. But you can prove that
Right.
there is nothing there with formal verification. So formal verification sometimes works for tests testing like I don't know, like quantum computing would work for computations. Of course, there
Yeah,
is
that's
nothing
actually a
quantum.
really good analogy.
Yeah, there is
There's
nothing quantum there, but
right.
sometimes it's like a super test which can explore many more combinations than you can imagine.
Mm-hmm.
Like exponentially many more.
Which is, I mean, it's fascinating because they're two completely different models. One of them is we're just going to test this thing, 100,000 times, a million times, whatever, and see if we can break. The other is, well, let's extract the logic here and try to disprove it. And if it can be disproven, it's broken. And so one of them seems really elegant, which is the form verification, but it's not always better because fuzzing is just,
right.
Despite sounding way harder, is oftentimes easier.
Yeah, sometimes it's very hard to prove things with formal verification. You can imagine some mathematical function which is iterative, like which has some loop where you need to go over this loop to compute it. Well, a good example of that is square root function, but maybe like logarithm and whatever. Not many contracts use those, but my smart contracts usually do use those. And it's really hard to write formal verification for that. What you need to do is to do some sort of loop invariant or something, but it appears really custom, so not easy to use, and yet it's, well, you kind of find practically everything with fuzzing, and what you don't find with fuzzing is when you didn't write a test for it, which is, I would say, which is also applicable to formal
That's right.
verification.
Yep, exact same
you don't
thing.
find something when you didn't write a spec for it.
Okay, so coming full circle back to YieldBasis, one, when? That's a big question.
When?
We see this front end here, and you get excited about it. Of course, you can put your email here if you want to get updates on it.
Right.
But when can people expect to be able to go get yield on their Bitcoin?
I think it's going to happen soon.
That's great. When? Soon. That's awesome.
Soon.
Now, a second
very
question.
soon. We say very soon when somebody asks that.
Hey, that's even better. So very soon is better than soon. We're getting in the next few whiles. I think so, like 5 whiles, 2 whiles. We're getting closer.
Well, I would say this, that everything relevant to launch in code is checked and audited. There are few minor things I'm double checking, but they're really minor, so like nothing affecting safety at all. And everything seems to be pretty much ready from the technical perspective. So that's why I'm saying very soon, but I wouldn't really be comfortable committing to the date yet.
And you never should. I think that's one of the worst things to do in DeFi, where you say a date
absolutely.
and then no one ever hits it or meets it. So I like the ambiguity. It actually makes me more bullish on the timeline than less. Another question though is, and I should have asked this earlier. You mentioned that there was either some sort of inefficiency or arbitrage or some source of yield outside of just like swapping. Now, maybe I misunderstood that, but is YieldBasis' only source of yield from the LP, the curve LP of the Bitcoin USDC, or is there institutional arbitrage happening from like SEX DEX liquidity? Maybe it was where the volume comes from. What was I missing?
It doesn't actually matter where where the volume comes from, whether it's direct swaps or arbitrage. It's, well, I mean, direct swaps are obviously a little bit better, but, well, if you think about it, how do direct swaps happen these days? Most likely people swap in some aggregator, right?
Yep.
Like, I don't know, cow swap, whatever. And aggregator swaps in places where it's most profitable to swap, right? And I would argue that even that activity is pretty much equivalent to arbitrage.
Oh yeah, I mean because it's looking at all the different rates and then closing the gap between those rates. Because
Right.
as the swaps go through, there's shortening the gaps between all the different options.
Right. So it's doing arbitrage by, I don't know, by informing user where to swap, but it's still like arbitrage, and
Yep,
that's
it's closing
why.
inefficiencies with volume.
Right, and that's why I think that we should assume that all the trades are arbitrage, whether they are
Intentional arbitrage or unintentional
right,
arbitrage.
exactly, and maybe sometimes you could get a yield which you shouldn't get. It's like when somebody is swapping and somebody else is sandwiching that guy.
Right.
So that is a bad yield, but it does happen sometimes. At least you should never count on it.
Yeah. Are you guys doing any MEV extraction at all?
I think the only thing we do towards, well, to kind of to earn more from arbitrage is dynamic fees. And we had dynamic fees since like forever, since 2021. So
And so dynamic fees are just when there's enough volume that you guys could still get swapped through and have higher fees to the end user.
So what happens is there is the way Curve Crypto Swap works. You have some price at which liquidity is concentrated, and current price can be where that price is, but it can be also somewhere else. Let's say Bitcoin started going up for some reason, or dumping, whatever, then the price suddenly shifted from this peak of liquidity concentration. And it usually means that volatility went up, and the fee of the AMM goes up if you have this difference. And that actually appears to be very important. I mean, the system still earns something when you have static fees, but with dynamic fees, it's actually much better.
Yep. Yeah. I mean, anyone who's been in the LPing game has realized that dynamic fees are the best place to actively LP. We've seen this not only on EVM but also in SVM. I think say what you want about Meteora and like their team and whoever.
Yeah, I think most projects on EVM kind of, I don't know, they kind of ignored dynamic fees for whatever reason. On Curve, dynamic fees were there forever. On EVM, I think like on Uniswap, we didn't really see those at all. And on
can you do dynamic fees? You can do dynamic fees with hooks though, right?
Yes, you can, but on Uniswap 3 you couldn't. And
that's right.
With Meteora, you of course can do dynamic fees on SVM, and
which is why like the JLP USDC LP is so nice.
Yeah, and yeah, that makes a lot of sense. Also, when you do dynamic fees, you reduce probability of sandwiching, because if somebody sandwiches, then
when there's a deviation, there's a fees high, so they're paying that fee.
Yeah. So they need to push the fee suddenly to be huge, and it becomes unprofitable for them to sandwich.
Oh, so an unintended benefit of
Yes.
this that I never thought of.
Moreover, I think that you can have a special, well, some fee which kind of eliminates sandwiches completely.
Because it makes them unprofitable.
Well, I mean, you can probably even prove it. Like your sandwich is trading one way and back, right?
Right.
And you probably can say that if you have fee, which is, I don't know, being more than, I don't know, 1/4 of price difference or whatever, then trade there and back charges more fee, then this sandwich attacker can profit from like shifting the bonding curve essentially. So something like that. So I think you actually can have dynamic fee which kills sandwiching completely.
I love it. It's fantastic. Now I know we're out of time, but I just want to ask you like a last question, which is, what should we look out for? Like, what should we think about when we think about YieldBasis? What haven't we talked about so far?
Well, I think we talked about everything. Maybe we didn't really talk too much in details about technicalities, but maybe that's not really needed for your listeners.
Maybe. I mean, we'll see. Well, if there's demand for the technicalities in the comments, then maybe we'll do a round two. Michael, thank you so much for joining. It was an absolute pleasure, and it was good to meet you and talk about DeFi and kind of relive a lot of DeFi summer, which I always have a little bit of nostalgia for. And listeners, have a wonderful rest of your day. Go check out YieldBasis, sign up, put your email in, get the alerts, get the notifications, obviously. Follow Michael on X if you aren't already. You probably are. Follow Curve, follow YieldBasis as well.
And
Go
follow
ahead.
YieldBasis on X, yes, because there will be, the news will be there.
And he's committed to a specific date, which is very soon. So thank you for watching and have a wonderful rest of your day.